What if the biggest IPO in American history was also the most expensive trap ever set for everyday investors? On June 12, 2026, SpaceX rang the closing bell at the Nasdaq. Stock opened at $150, closed at $161, up 19% in a single trading day. Market cap hit $2.1 trillion, larger than every U.S. defense contractor combined. And just like that, Elon Musk became the first trillionaire in human history. The headlines were electric, the energy was real, and if you were watching from the outside, it looked like the greatest wealth event of our lifetime. But buried 174 pages deep inside the IPO prospectus, there is a timer. A clock, a bomb, basically wired to go off sometime in late August. If you have a 401k, an IRA, a Roth, or any retirement account at all, you are sitting inside the blast radius right now. The headlines on June 12th didn't lie. They just left out the important parts. And honestly, that's so much worse. If you stay until the end, you will understand exactly how this was structured and why it directly affects your money. If you think people deserve to know what the headlines didn't tell them, hit that like button, drop a comment telling me if you already own index funds, and subscribe so you never miss what Wall Street hopes you overlook. Most IPOs follow the same predictable script. A company prices its shares, hedge funds grab their allocation, retail investors pile in on day one. The stock moves up or down, and everybody goes back to their lives. It is a cycle Wall Street has run on autopilot for decades. Nothing about it is particularly exciting, and honestly, nothing about it is particularly dangerous either. You know the rules, you know the rhythm. The game is familiar. The SpaceX IPO is not that, not even close. What happened on June 12th was something entirely different, a structure so specific, so deliberately engineered that the mechanics themselves are the entire story. And once you see how it was built, you cannot unsee it. There are two mechanisms baked into this listing that no major IPO has ever combined at the same time. The first one is an accelerated entry into the Nasdaq 100 index, meaning billions of dollars in passive funds would be forced to buy SpaceX shares far sooner than any stock in history has ever triggered that kind of automatic buying. The second mechanism is a shortened insider lockup, meaning the people who have been holding SpaceX equity for years, some of them since 2008, would be cleared to start selling much earlier than the standard timeline any public company follows. Read those two things together and the picture becomes very clear. Buyers were pushed in first. Sellers were released second. And that sequence, that exact order of operations, was not accidental. It was not a coincidence. It was not just how things played out. It was designed that way from the beginning with precision. And the details of exactly how deep that design goes are what we need to get into right now. About 6 weeks before SpaceX went public, Nasdaq changed a rule, not with a press conference, not with a major announcement. Quietly buried in a regulatory update that almost nobody in the financial media stopped to read. The rule was about how new stocks get added to the Nasdaq 100 index, and the change was not small. It was the kind of change that moves billions of dollars. The old rule required a 3-month waiting period after a company listed before it could be added to the index, and that rule existed for a genuinely good reason. It gave the market time to breathe, time to price discovery, time to figure out what a stock was actually worth before hundreds of billions in passive index money got force-fed into it. 3 months was a guardrail. The new rule cut that down to just 15 trading days. The guardrail is gone. Here is why that matters for your retirement account. There is over $650 billion tracking the Nasdaq 100 right now. Every single fund tied to that index is legally required to buy whatever Nasdaq tells it to buy. Bloomberg ran the numbers, and SpaceX is expected to land between a 0.47 and 0.7% weight inside the index, which translates to roughly $3 to $4 billion in automatic, mandatory buying. No human decision involved. No analysis, just obligation. And then there is the float multiplier. For companies with a small free float, which SpaceX engineered on purpose, Nasdaq treats that float as 3 times larger than it actually is. So the forced buying becomes even more aggressive than the supply can handle, pushing the price higher and higher. If you hold a Nasdaq 100 fund in your 401k, your IRA, or your kid's 529, you did not click anything. You did not authorize anything. You did not get a single phone call. But very soon you are going to own SpaceX at today's price, and that is only one half of what was built here. For about 40 years, the lockup period has been one of the most basic protections built into the IPO process. The rule is simple. After a company goes public, insiders, executives, early employees, venture backers cannot sell their shares for 180 days, 6 months. The idea is straightforward. Give the public market time to stabilize, time to absorb the new stock, time to establish a fair price before the people who got in at pennies start flooding the exit. It is not a perfect system, but it is a guardrail that has protected retail investors and retirement accounts for decades. SpaceX did not follow that standard. Instead, they wrote their own lockup, and the difference is not subtle. Under the terms buried in that prospectus, insiders and employees are permitted to sell up to 20% of their vested shares just a few weeks after. SpaceX releases its first earnings report as a public company, not 6 months, a few weeks. Now connect that to the calendar. SpaceX's first quarterly earnings report is expected sometime in July or early August. Add a few weeks to that and you are looking at insider selling beginning in late August. That is the timer. That is the bomb. And the fuse is already burning. Think about what that actually means from the insider's perspective. Picture someone who spent 10 years at SpaceX taking stock compensation instead of a higher salary, accumulating shares at a cost basis of literal cents. That person is now sitting on equity priced at $161 per share, and in a matter of weeks, they are legally cleared to sell. And here is the part that should make every retail investor and every person with a retirement account stop cold. SpaceX's own CFO publicly described the retail investor base as incredibly supportive, which, translated from corporate language, means something much more specific than it sounds. Fast forward to late August, the first earnings report has dropped, the lockup window has opened, and insiders who have been sitting on shares worth cents for a decade are now legally free to sell at $161 a share. That supply is coming into the market. It is not a question of if, it is a question of who is on the other side of that trade. And when you actually look at who is left to buy, the answer is deeply uncomfortable. Start with passive funds. The Nasdaq 100 index trackers already did their buying. That $3 to $4 billion in forced purchasing happened right after listing, driven purely by the rule change we talked about. Those funds are now full. They are not sitting on cash waiting to absorb insider selling. Their mandate does not work that way. They buy once to hit their weight and then they hold. The passive bid is gone. Now look at active funds and hedge funds. These are the players who actually run valuation models, who build spreadsheets, who stress test assumptions. Morningstar, one of the most respected independent research firms in the world, ran the numbers and put SpaceX's fair value at $780 billion. The market is currently pricing the company at $2.1 trillion. That is not a minor disagreement. That is a $1.3 trillion gap, a difference larger than the entire GDP of Canada. No serious institutional investor is stepping in front of that math to absorb a wave of insider selling, not at these prices. So if the passive funds have already bought and the institutional money will not touch it at this valuation, the question becomes almost painfully simple. Who is left? Who is the buyer of last resort when the insiders start selling into this market? And the answer, when you strip away every layer of complexity, points in one very specific direction. Before anyone calls this a conspiracy theory or an overreaction, let's talk about what the historical record actually shows. Because this pattern is not new. It is not a hypothesis. It is a documented, repeatable sequence that has played out in some of the biggest IPOs in modern market history. And once you see the timeline, it is impossible to unsee. Facebook went public in 2012 at $38 a share. By September of that same year, after the lockup expiration, the stock had fallen 54%. More than half of its value gone. Retail investors who bought into the hype were left holding losses while insiders had already cashed out. Uber went public in 2019 at $45 a share. Same story, different company. By the time the lockup expired and insiders were free to sell, the stock had dropped 44% from its IPO price. Then there was Snap, then Lyft, then Alibaba. Different sectors, different products, different narratives, but the same structural sequence playing out with almost mechanical precision. The companies changed. The pattern never did. And here is what makes that pattern so important to understand. This is not bad luck. It is not a coincidence that happens to repeat itself across a dozen major listings. It is the direct result of how these deals are engineered from the beginning. Insiders accumulate shares at near zero cost over years of private company growth. The IPO creates a hype cycle that drives retail demand to its peak. Then the hype fades, the lockup expires, the insiders sell into whatever demand is still left, and whoever is holding the bag at that point absorbs the entire correction. Take away the rocket, take away the mythology, the Mars mission, the Starlink satellites, the Elon Musk brand. Strip all of that away, and what you are left with is the exact same script Wall Street has run for 30 years. The only thing that changed is the costume. And this time, the costume is a rocket. Here is what actually bothers me the most about all of this. None of it is hidden. Not a single piece. The accelerated index entry rule is published directly on Nasdaq's own website. The customized lockup terms are sitting in the prospectus that was filed with the SEC, a public document that anyone can pull up right now. The Morningstar fair value estimate of $780 billion is available on any Bloomberg terminal. The Facebook chart, the Uber chart, the entire historical pattern we just walked through, all of it is on Yahoo Finance, free, 3 clicks away. This information was never buried. It was never classified. It was always there. So why did none of it make the headlines on June 12th? Why did none of the major financial networks lead with any of this? The answer is not complicated. Because that day, the story that captured every screen, every front page, every social media feed was Elon Musk becoming a trillionaire. It was the Nasdaq bell ringing. It was a Falcon 9 rocket launching from Florida, scheduled, by the way, just 1 hour before the market opened. The spectacle was so perfectly constructed that the actual financial mechanics underneath it never had a chance to compete for attention. What actually happened on that day, described plainly, is this: a customized lockup structure engineered to maximize insider exit velocity, inside a passive demand environment that was itself manufactured through a quiet regulatory change 6 weeks earlier. That is the accurate headline. And you already know why that title never went viral. The bell that rang on June 12th was ringing for the people who were leaving, the ones walking out the door with decade-old equity priced at pennies, now selling at $161. The question that matters, the one that should stay with you, is whether you heard that bell for what it really was, or whether you were too busy watching the rocket. There is a clock running in this market right now. Late August is not far away. The earnings report will drop, the lockup window will open, and the insiders will begin selling into whatever retail demand is still standing. Nobody is going to ring a second bell when that moment arrives. No headline will prepare you. No notification will warn you. The mechanism will simply execute exactly as it was designed to. If you made it this far, you already know you are not here for the easy version of financial news. You are here because you want to understand what is actually happening beneath the surface of the market before it happens to you. So subscribe to this channel, because this is exactly what we do here every single time. And if this video spoke to you, if something clicked, drop the words "I see it" in the comments right now and leave a like. It takes 1 second, and it means everything for this content to keep reaching people who actually need it. The next video is already on your screen. Watch it, because the patterns we just broke down do not stop at SpaceX. The bell rang on June 12th for the people who were walking out the door.